Okay, welcome back. Welcome to video number 9. In video number 8 we got perspective by looking at and defining what type of market we're actually in, whether it was a bull or a bear market as defined by the professional trader definition. Now we're going to move on to get more perspective. We're going to try and get perspective on what drives global stock market returns. And what really drives global stock market returns is a country's income, gross domestic product. And we're going to look at what gross domestic product is and get historical perspective of gross domestic product, GDP, relative to major stock markets and stock market returns around the world. And we're going to look at gross domestic product primarily in the United States. You're going to see when we go to the presentation why this is so important. And we're going to correlate this with the biggest stock market in the world. We're going to correlate this with the S&P 500. And you're going to see that actually when we do this, the odds of making money, if we follow and are able to predict GDP using the stock market as a proxy for that prediction, you're going to see that the odds are going to be now stacked massively in our favour. We're also going to compare US gross domestic product versus the Eurozone in its entirety and also Chinese GDP. Now when you add up all of these regions together, you actually get to 50% of the world's total income. And if we can find a way of predicting the United States gross domestic product, the Eurozone gross domestic product, and Chinese gross domestic product, we're going to have a very, very good idea of global stock market returns in the future. And this is what we move on to next, after we've gone through defining why GDP is so important and looking at the reasons why it's so important. And now we're going to go over to the stage, and I want you to really focus on the size of the United States and why predicting US GDP becomes one of the most important things for a professional trader. Once you've got this understanding of the relative size of the United States and the Eurozone and Chinese GDP versus the rest of the world, you're really going to understand what drives stock market returns. And then we're going to move on to the next point, where we're going to try and start predicting US GDP, Eurozone GDP, and Chinese GDP using indicators that predict the future. Okay, let's go over to the presentation, and I'll see you for a summary after the presentation. In a top-down systematic process, the first thing we do is we look at GDP, gross domestic product. First thing we're going to look at is why it's so important. Once you realise the importance of certain parameters of global GDP, you'll start appreciating really why markets move the way they do. And this sits right at the top. This is our worldview. Is GDP going to grow? Is GDP going to contract? Is it going to grow in the US, contract in Europe, grow in China? These are the views that you've got to have. Those views are going to dictate your direction in your portfolio across all asset classes. So if you think GDP is going to contract and you're very, very long everything, your book represents, your trading account represents the total opposite of what you believe. So you've got stupid positions. Your book has to be an absolute perfect representation of what you think is going to happen in the future. So let's get some definitions straight. Nominal GDP, total income of a country for a given year. Real GDP, adjusted for inflation, adjusted for prices. Recession, 2 consecutive quarters of negative real GDP. When you see a guy on TV, an economist, talking about GDP, they mean real GDP. So they use the term loosely GDP, but what it means is real GDP. We know what correlation is. I'm not going to tell you what that is. You should know. Leading indicators, indicators that move before the economy as a whole. Lagging indicators, indicators that move after the economy as a whole. So what are we interested in? We're interested in leading indicators that do what?
Predict the movement of the economy.
So what's the economy? Real GDP. You can have an appreciation of nominal, but what really matters is real GDP. And this is the causality profile of essentially the stock market. Real GDP, and I'm just going to refer to it now as GDP, just assume that it's real GDP. Yeah? Real GDP growth leads to growth in earnings of companies, and the growth in earnings of companies lead to the value of the S&P 500 to go up. However, the S&P 500 is a leading indicator in itself and predicts the future rise and fall of GDP, and therefore earnings. So by the time a company reports, the market's already moved. And by the time GDP is reported, the market's already moved. GDP is reported every quarter, and it's backwards looking. It tells you what happened in the last 3 months. The market tells you what's going to happen in the future. Why? Because everyone trading that market and using it as an expression of their view in the world is trying to predict the future and using leading indicators to do it. So by default, the market becomes a leading indicator itself. Make sense? What we're going to look at now is a crude correlation of S&P 500 and GDP going back to 1950. So you guys can spend lots of money on degrees, tens of thousands of pounds, learn how to do correlations, but if you just stick two variables in a spreadsheet and give them a 0 or a 1, if they move together or they don't, in a given time horizon, you'll still get literally the same answer. So the market trades every day, but GDP is reported every quarter. Q1 GDP, so January, February, March, is reported at the end of April. Q2 GDP is reported at the end of July. Q3 GDP is reported at the end of October. And Q4, full year GDP, is reported at the end of January for the previous year. But the market trades every day. So if they move in the same direction, we can use the S&P 500 to predict GDP and just buy it and sell it now. Does that make sense? If you've got two variables, there's only 4 things that can happen. They either both go down, they both go up, one goes down, one goes up, or one goes down, one goes up, one goes down. There's only 4 things that can happen over a time period. Yeah? So what you do here, you take the GDP numbers every quarter that are reported 1 month after the quarter, you time lag it, so you look at, so you put it in as the month. So Q1 is April, yeah? And you take the S&P 500 on a monthly basis. So for every 1 number GDP is reported, there'll be 3 closing prices for the month of S&P. And then you say whether the S&P was up or down in the period before GDP was reported. Make sense? So let's start here with this one. At the end of Q1, 1950, the GDP of the United States was 1.696.8 trillion. 1696.8 trillion. Okay, that's trillion dollars. Anyone know what the GDP of the US will be this year? And what about last year? Who said 15? It's 15, 16 trillion. So you can see how much GDP has grown in the US since 1950. The S&P 500 in April was 17.53, April 1950. The S&P 500 is at 1540 now, 1,540. So you'd have done pretty well if you bought it at 17.5. It's a big return. But by the way, if you'd have day traded it every day, you'd have lost money. Second quarter, GDP went up. So this is an annualized GDP number, by the way. So every quarter you get the annualized GDP for the US. So it goes up from 1696.8 to 1747.3. So it's reported in that period as up. What happened to the S&P 500? It went from 1753 to 1877. Sorry, 1764. So it was up. So the S&P 500 was up in that month, in that quarter, and GDP was up in that quarter. Yeah? So what do? Well, we give them a score in different columns. And we have 4 situations. A 0-0 situation is when, in a quarter, the S&P 500 goes down, and then GDP is reported down. The 1-1 situation is in a quarter, the S&P 500 goes up, and GDP is reported up. So what's a 0-1? S&P 500 down, GDP up. And then 1-0, S&P 500 up, GDP down. What do we think the results are? Someone have a guess? Which one's got the most numbers in it? 1-1. Market's gone up over 60 years. Why has the market gone up? Because GDP's gone from 1.1696 trillion to 15.5 trillion. Here's the results here. %60% of quarters. So we've got a total of 245 quarters. The S&P 500 goes up, and then after that move, GDP is reported as being positive versus the last quarter. 146 quarters out of 245. 19 are reported as S&P 500 moves down, and then GDP is reported down. So they both move in the same direction 67% of times. 67% of quarters in the last 60 years. What happens when it doesn't? What happens when they move in the opposite direction? Well, the vast majority of times, the S&P 500 goes down and GDP is reported up when it goes wrong. 25% of times. So why would that actually happen? It's because the expectations in the stock market of GDP are too high for that current quarter. So the market goes down on profit taking, and then GDP is actually reported up. So expectations get ahead of themselves, and the market prices everything in too much.
Make sense? You can see only 7% of times since 1950, S&P 500 has moved up and GDP has gone down. So you can pretty much say that's never going to happen. Very rarely. So what's going to happen most of the times, one of two things is going to happen. They're either going to move in the same direction, or when they don't, the expectations in the market have become too high. That's it. So historically, GDP explains 67% of S&P 500 moves on a quarterly basis. What does that mean in terms of odds? It means we've now got 3-2 odds in our favour if we can predict it accurately. Better than 50-50 and better than day trading. This is why when you increase your time horizon, you have a better chance of making money over the long term, because you're starting to stack the odds in your favour. When it doesn't, the vast majority of times it's because S&P 500 moves down, GDP doesn't go down, goes up, and we get profit taking or short-term panic in the market. That happens 25% of times, so the odds of that happening in a given year are 4-1 against. Make sense? So if there's 4 quarters in a year, what should we expect once a year? We can expect some profit taking in the market, where the expectations of the market become too high, and then GDP's reported after, but the S&P 500 goes down. GDP's up, but the S&P 500 has gone down in that quarter. We've got 4 quarters in a year. Now what happens if we predict GDP fundamentally and we manage to take profits at the right time? But if you do that, you're an absolute superstar. It basically means you're going to be right 93% of the time in your life. 93% of quarters from now till the day you retire. But if you're getting that right, you'll be retiring very young. So mentally, as professional traders, you go in every year, objective to make money, predict GDP, 1 to 3 month time horizon, use the stock market to represent my view. And then when I think there's going to be profit taking, I take profits. And then GDP's reported and we start again. It's literally that straightforward. That's everybody's approach. You're not going to be right 93% of quarters in your life. But if you can be right somewhere between 67 and 93, you can't fail to make money. You just have to time your trades right. Now this is only on indexes, commodities. You also, because this is aggregate demand in an economy, so commodities are most commodities are cyclical. So you get your commodities views globally by predicting global and regional GDP. You get your currency views by doing that as well. And you get your rates views by doing that as well. Why? Because rates policy responds to predicted GDP. What do we think all of the policymakers around the world do when they set rates? Do they wake up one morning and just decide, we're going to put rates up today? Because I had a funny dream last night. Of course not. They respond to real things that are happening that are going to affect GDP in the future. So you can have views on rates. What's a central bank going to do if aggregate demand is collapsing? They're going to smash rates lower. You can have views on these things. That's where you get them from. So you get your views across asset classes, stock market, indexes, indices, cyclical commodities, currencies, all your major currency pairs, and rates. You get all of those views from your view on the world. And there's multiple trades you can do. So if you don't want to even become a guy or a trader that wants to trade anything else except trade large cap indices, futures, commodities, currencies, and rates, you don't want to trade anything else other than that. So you don't want to trade stocks, you don't want to trade options, you don't want to trade in, sector ETFs, you don't want to trade anything, you don't want to go too deep. That's your approach. You can just literally have a world view and trade these things based on your world view and try to take profits at the right time. So back to the perception of what a professional trader does, that's what they're obsessed with. Professional traders and hedge fund managers are obsessed with predicting GDP. Let's have a look at some charts. A picture paints 1,000 words. We like charts. Traders love charts. Okay, let's get some GDP appreciation for the United States. Nominal GDP from 1791 to 2011. Goes positive, early 1950s. Goes negative, 2008, 2009. UK nominal GDP, positive from 1946 to 2009. US real GDP, last 4 US recessions, 1973 to 1974, 80 to 82, double dip, 91, and 2008 to 9. What was special about 2008 to 2009? What was special about that recession? Anyone know? Remember what the definition of a recession is? What was it? 2 consecutive quarters of negative real GDP growth. Why was the 2008-2009 one special? Because we got 4 in a row. So Q3 and Q4 08, Q1 and Q2 09. That hadn't happened for 70 years. That's why it was special. That's why you're now seeing, that's why rates are now at 0. When we flick onto the next page, we're going to look at the UK. What do we think the UK looks like in terms of the last 4 recessions? What do you reckon? Exactly the same. You don't need to know anything about the United Kingdom to trade the FTSE. Because UK GDP is just US GDP with a K. There they are, overlaid. Do you think the UK has any power in the world whatsoever? When you drive down Embankment and you look at Parliament, what do you see? What do you see when you look at Parliament? I see a submissive institution that's subject to European law. So they've got no power. What do you do when you drive past the Bank of England? What do you see? You might see a central bank. I see a puppet of the Federal Reserve. The last 200 years proves it. If the US is growing, the UK will too. If the US sneezes, the UK will catch a cold and contract as well. Literally, anything you do as a trader if you trade on the back of UK statistics that are backwards looking, you're an idiot. If you trade the FTSE based on UK retail sales, you're the last person to the party. Because it was already predicted 12 months ago. And it wasn't predicted by looking at UK statistics, it was predicted by looking at US statistics, predicting US GDP. So it seems that if you can predict US GDP, you can also predict UK GDP. You don't need to look at anything in the UK. It's irrelevant. What's your view going to be on the Taiwan index if US GDP is collapsing? Sell Taiwan. What's your view going to be on the Hang Seng if US GDP is collapsing? Sell Hang Seng. Why is US GDP so important? So here's the 2011 numbers. So 2012 numbers are going to come out soon. Could be quite interesting. So top 25 economies in the world. US economy, 2 times bigger than China, a little bit more. If you add up the 24 countries outside of the US, you get to 43 and a bit trillion. US economy is still a third of that number. The US economy just drives global GDP. Pretty much you can have a view on everything if you can predict US GDP. But we look collectively in Europe at the Eurozone. Because when you add up all of these countries that have a common currency, the euro, you get to 13 trillion. So we can have a view on the US and we can have a view on the Eurozone in its entirety. So it's 85% of the US economy. If you add them both up, global GDP, 70 trillion, US is 22%, Eurozone is 18.5%. But we have to look at China as well. Why? Because it's growing at 8%. And if you add them all up, you get to 50% of the world's GDP. And that table there basically says if everything stays the same as it is now, China will be the biggest economy in the world in 2025. So that's why we have to look at it. The future of GDP and the future of global stock markets will only be dependent on a few things. Whether the US can get itself out of its mess, and Chinese growth. Because China's going to be the biggest economy in 2025. So this is how we get our world view. Predicting GDP. Historically, global GDP is driven by US GDP. It's the most important economy in the world, by far. Just think of the US as a big, obese consumer. And the whole world depends on the consumption of that consumer. If that consumer goes on a diet, the rest of the world is screwed. It drives global GDP and drives S&P 500 returns. And S&P 500 returns are going to drive the rest of the world as well. So we've got to try and predict US GDP, Eurozone, and Chinese GDP. That makes up half the world. And we can have views on either or. We can be bullish on the US, bearish on China. We can be bearish on the Eurozone, bullish on China. And then you have an overall view as well on the whole world. So you can just, if those three economies are contracting, global GDP will be lower. And stock markets will go lower now before they get reported as going down. Because people will start selling 6, 12 months ahead of it actually happening. Because they'll be told by the leading indicators that it's going to happen.
Okay, welcome back. I hope you managed to get a good idea of the numbers there. And the numbers that we looked at really were twofold. We looked at the size of the United States, the size of the US versus the rest of the world, the top 25 nations by gross domestic product. That was the first thing. Second thing really that we looked at, and this is the main thing, because the US is really so important in terms of its gross domestic product and its size, we took GDP and we had a look from 1960 to the present day, and we discovered that there's a very high correlation between the US gross domestic product and quarterly stock market returns. Now, if we're going to be using the S&P 500 as a proxy for expressing our views on future levels of GDP in the United States, this is what we want to see. We want to see that they both move in the same direction. And the conclusion that we got to was actually over the last 50 or so years, what's happened is that the S&P 500 manages to predict GDP. And it does this 2/3 of the time. So now when you compare this to day trading, for example, when we looked at day trading in the first part of the video series, we're no longer looking at a situation where things are 50-50. We're no longer looking at a situation where if we day traded the S&P 500 every single day from 1960 to present day, we would have lost money. Now, if we'd have followed on a 1 month, 3 month time horizon and predicted GDP 3, 6, 9 and 12 months out, we would have actually made a hell of a lot more money. And this is what you have to do as a professional trader. US GDP is by far the most important thing that you will ever predict, because it tells you the direction that you should be in your portfolio, not just in the United States, but also probably for the rest of the world. And when we looked at those numbers, we saw, given the 2/3 correlation, as in the S&P 500 predicts GDP and GDP moves in the same direction as the S&P 500 2/3 of the time, or 2/3 of quarters throughout history, when the S&P 500 is actually wrong in predicting GDP, it's usually wrong for a specific reason. And that specific reason is actually expectations of GDP growth become too high. So what you have to try and do coming into every single year as a professional trader is to try and predict GDP for at least 3 quarters out of 4. Because we're not superheroes. You know, every professional trader knows that they're going to get it wrong sometimes. So we allow ourselves to get it wrong for at least 1 quarter a year, knowing that even if we get it wrong 2 quarters a year, we can actually still make money if we have good risk management. So if we come into each year and we try and get 3 quarters out of 4 correct, then we're going to be right 75% of the time. And in each quarter, we're actually always looking at least 6 to 12 months ahead, trying to predict US GDP growth in the future. Now, predicting GDP growth in the United States can provide us with a good idea of long or short or flat or market neutral in our portfolio, not just in the United States, but also globally. But we have to be prudent. We have to look at the Eurozone and Chinese GDP as well. Because what you notice is the Eurozone is pretty much the size of the United States in its entirety, but also China is growing at 8% per annum, which means by 2025, China will actually be the size of the United States. So China is becoming more and more important every single year. So when we predict GDP globally as professional traders, we try to predict US GDP first of all, because that is the biggest and most important. historically and at the moment. We try to predict Eurozone GDP because that's the common currency area that is the same size as the United States, or just a little bit smaller. And we try to predict Chinese GDP because every year it becomes more and more important relative to both the US and the Eurozone. So we can also get an idea not just of global direction in stock markets from US GDP, we get global direction in stock markets from adding them all up. And if we add them all up and find that Eurozone GDP growth cancels out US GDP growth, or China cancels out both Eurozone and US, then our overall picture might look very different. And we may want to even look for geographical exposure. So we can look at being long the US, short Europe, long China, short Europe, long the United States. So we get a global perspective, but we also get a regional perspective. Now that you understand why GDP is so important, we have to learn now how to actually predict it. So what is there out there in the world that predicts GDP 6 to 12 months in advance, or with a good time lag, so we can use global stock markets as our proxy for predicting GDP and taking direction in our portfolio? Well, we're going to move on to video number 10 now, and you're going to find out that what we call these indicators are leading indicators because they lead GDP and they lead the stock market. And the stock market itself is actually a leading indicator because it leads GDP. So let's go on to video number 10. And in video number 10, we're going to start with the biggest leading indicators in the world. You can always add more in if you want, but you have to get the principle and interpret it right. Remember this principle that we spoke about in the first section of the series. The principle that we spoke about in terms of professional traders' perspective and professional traders' approach was to take the information that's relevant in the world, that 3% of information that is potentially going to make you money, and to cut out all of the noise. Well, this is the information. The information, 3% of information that's relevant, is really the importance of GDP and predicting GDP successfully. And we do that with leading indicators. But you have to interpret the leading indicators correctly and then turn it into real hard dollars. Well, we're going to learn this in video 10 now. We're going to start off by trying to predict GDP with the biggest indicators in the world, the biggest leading indicators.